All right. Seems like we're up and going. So, again, thank you all for joining. For those that are not familiar with who I am, my name is Marcus Rather. I'm a financial advisor here as a representative of Cetera Investors here in the Glen Allen, Virginia location of Cetera Investors, servicing my clients throughout all different states for all of their financial needs. Reason I'm addressing this topic. So, a few disclaimers to note. One, I am not a tax advisor. I'm not a tax professional. I'm not in the business of filing taxes or giving tax advice. With that disclaimer, you may ask, well, why the heck am I talking about this? And the answer is, as a financial advisor, taxes influence or disrupt, if you will, different flows of money, whether you're earning it, receiving it, giving it, making it. There's taxes to be paid on all of those different types of transactions. So understanding that my clients are looking to live a financially free life, also want to overcome the challenges that they may face with taxes. So first disclaimer, again, not in the business of filing taxes. Unfortunately, I know you would love for me to be able to do that, but that's not the role that I play. Second disclaimer, these tax rates, as you see, are for the tax year for 2025, meaning a lot of the numbers that we're going over today, you may not see until you go to file taxes for or in 2026. That being said, some of these numbers that we go over today, I will be referencing back to the 2024 year for which you will be filing those taxes anywhere between now up until the filing deadline in April. Some of these numbers are going to be different for 2025, but again, I will be referencing back to 2024. Third disclaimer. A lot of these numbers, a lot of the context of tax are applicable for the Tax Cuts and Jobs Act that is currently our law now and are subject to change. For those that may not be familiar, the Tax Cuts and Jobs Act was passed in 2017 following Trump's initial or first presidential election. Those tax laws have been in effect since 2017 and are due to sunset in 2025. So if there is no change in legislation, we may be experiencing another change in our tax law, possibly reverting back to what we had before Trump took office, or there could be an extension of some sort. So there is going to be some tax change this year, whether they renew the current Tax Cuts and Jobs Act for another 4 years or longer. There could be a change and a reduction, there could be a cut, or there could be an increase. That being said, there's going to be a change. So that's the third disclaimer. Fourth thing I will acknowledge is that throughout the conversation, there may be some definitions that I will do my best to define and try to simplify. Again, not a tax professional, not a tax advisor, so I don't want to give any tax advice. The information given today is used for educational purposes, but I will do my best to explain a lot of the terminology that you hear today. Now, my agenda is to do this as quickly as possible. I don't want to hold you past 30, so please pardon me if I'm speaking rather quickly. With that being said, I do encourage you to utilize one of three different resources. One, the Q&A feature on your Zoom. For those people that are joining by Zoom, or if you're able to do it on your laptop or mobile device, utilize that Q&A feature. I will be monitoring the Q&A throughout our experience today. Second resource, my contact information, which was on the previous screen. If you have questions, if you have feedback, please reach out to me. I am accepting all forms of feedback. My phone number is provided there, 804-346-4670. With my extension, I also accept communication by email. The third resource would be a replay. Maybe there's some things that you hear throughout our experience that doesn't quite stick. Maybe you haven't heard it correctly, or maybe it's the first time hearing it altogether. So with approval from Cetera, this will be available for replay that you can find on my YouTube channel, as well as on my website found at the bottom of your screen. So kicking into 2025, first disclaimer to give for 2025 tax brackets, there are still 7 tax brackets. So the tax brackets have not changed. The percentages have not changed. What has changed are the dollar amounts at which are going to be taxed at those rates. Now, taking a moment to educate, just in case someone may believe taxes are, for example, if I made $100,000 in 2024, if I look at the brackets, I see 100,000 falls within the 22% tax rate. So my thought may be, well, I owe 22% taxes on all $100,000 of my taxable income. That is not entirely the truth. Taxes are what we call progressive, meaning, or you can consider them somewhat like buckets. So the first $11,925 that I earned of my 100 are taxed at the 10% marginal tax rate. The dollars that I've earned between 11,925 up to 48,475, those would be taxed at the 12% rate. For the dollars in excess of 48,000 up to 100, since that's the total amount of taxable income, those dollars would be taxed at 22%. So ways that you can read this chart are, well, if my taxable income is 100, well, I start with a base amount of $55,578 plus 22% tax rate, or 22% tax on the dollars over 48,475 up to my total taxable amount. So as you can see for 2025, the dollars from 0 to 11,925 are taxed at 10, and then all the way up to the 37% bracket. If anyone has taxable income over 626,350 and they're filing single, those dollars would be taxed at the 37% tax rate. That is an increase from 609,350 for 2024. Now, for those couples that are married filing jointly, essentially the numbers are about double or approximately double. So for married filing joint or surviving spouses, those who may have lost a spouse in 2024 and who are eligible to still file married filing jointly for the 2024 tax year, you can see what those dollar values would be for 2025. So the lowest bracket you can see goes up to 23,850. Filers with taxable income over 751,600 are in the top 37% tax rate. For 2024, for those that are preparing to file, that number previously was 23,200 at 10%. The 22% range was 94,301 to 201. So you can see there was a slight increase for the 2025 numbers for this applicable year. And at the bottom, 2024, any dollars over 731,200 would be taxed at the top rate of 37%. For those who are filing head of household, this could be anyone that is single but has a dependent, whether it's a child, parent, whatever the case may be. Anyone that's filing head of household, the bottom rate still 10% all the way up to 37%. So again, still 7 different brackets. Those rates are still the same. The rates have not changed. But again, the dollars that fit into those rates are what have increased. So for head of household filers, you have 0 to 17,000 of your taxable income taxed at 10, 17,000 to 64,850 at 12, so on and so forth. On the top bracket, 37% for any taxable income over $626,350. Those dollars are taxed at 37%. So the lesson here, truth be told, again, understand that tax brackets are progressive. There is a difference between your marginal tax rate. Marginal tax rate says what amount of taxes are taxed, or what percentage of taxes do you pay on your top dollars. The effective tax rate is essentially the amount of taxes that you pay in proportion to your total taxable income. That's what is known as your effective tax rate. For those that are married filing separately, essentially you're looking at, again, a single tax filer bracket. Again, 0 to $11,925 taxed at 10%. Any dollars over 375,800 are taxed at the 37% tax rate. Now, estates and trusts. This is something I believe most are not quite privy to. If you were someone who has a estate, or if you have established a trust with a separate tax ID, these tax rates are compressed. As you can see, there were 7 tax brackets for those who were single, head of household, married, or married filing separately. If you are someone who owns a trust and that trust has a separate tax ID and that trust has a separate tax filing, these are the marginal tax rates for trust. So any income, any capital gains or things along those lines, mostly income that are earned in the trust. The first 3150 in earned income are taxed at 10%. But you see, it doesn't take much of earned income to reach the top bracket for estates and trusts. So any income in excess of 15,650 would be taxed at that 37% marginal tax rate. That is an increase of a few dollars. For 2024, that number was 15,200. Now for 2025, throughout this year, that number is 15,650. Standard deductions. Why are we talking about standard deductions? Again, with the Tax Cuts and Jobs Act that passed in 2017, it did reduce some of the things that you were eligible or able to write off for adjusted gross income as a top line deduction. But now the bottom line deductions, also known as your itemized deductions, this identifies what amount in itemized deductions you may have to pay or may have to have in order to use the itemized deduction opposed to the standard deduction. Now for 2024, the number that you want to know for 2024, again, what you may be filing for this year, the standard deduction for individuals, single or married filing separately for 2024, that number is 14,600. For those who are filing head of household, the standard deduction is 21,900. Those who are married filing jointly and or qualifying widower, that standard deduction is 29,200. If you're a dependent filing your own tax return, it was 1,300. As you can see, starting in 2025, they did increase those numbers. So as we go through the 2025 tax year, and you're wondering, well, what amount of expenses or deductions will I be eligible to take to outpace or to use that? Understand that the standard deduction for 2025, someone married filing jointly and qualifying widower, is now 30,000. So it increased by 800. For single or married filing separately, that amount increased by 400 to 15,000. Head of household increased to 22,500. And if you're a dependent filing your own tax return, that would be 1,350. Additional deductions. These are exciting. I actually got some excitement out of my father this year when I recognized that he was 65 and filing for the first time as a 65-year-old. For those who are over 65, or if you happen to know someone that is blind, they receive an additional standard deduction. Why that's good? That's an additional deduction that you get to use. Why that can be controversial? The higher your standard deduction, the less likely you are to be able to use an itemized deduction. So for those that are blind or over 65 for 2025, again, these numbers are going to come into play in 2026. You have an additional standard deduction of 1,600. But for those that are blind or over 65 and are unmarried and you're not a surviving spouse, that is 2,000. What that means for two couples who are 65 or older, both individuals have an additional standard deduction of 1,600. If you are a single person who is not married and you're not a surviving spouse at that time, your standard deduction addition is a little bit higher at 2,000. Those numbers for 2024, what you may see in your tax filing this year, is 1,550 for 2024. If you're blind or over 65, unmarried, and not a surviving spouse, is 1,950. So you see, they did increase it for 2025 for our tax year 2025, filed in 2026. Child tax credit, those numbers did not change. So it's a good time to parenthetically pause and describe what a credit is. Previously, we were talking about deductions. The standard deduction and itemized deduction are things that reduce your adjusted gross income to determine your taxable income. You can see that on your 1040 form or whatever your tax form is. A credit is something that goes towards or reduces your actual tax liability. So where a deduction can reduce things from your revenue to determine your AGI, or your AGI to determine your taxable income, a tax credit is something that reduces your actual tax liability. Now you see the parentheses 1,700 refundable. Oftentimes you may be someone that has a return, meaning you paid more than what your actual liability is. So because you paid in excess, you get a return. For those cases where you may have a return or you may be at zero, of the $2,000 credit that you would get to reduce your tax liability, only $1,700 is refundable. Where this can come into play, if you have a $0 tax liability before you were able to use the credit, you can receive the credit, but you will only get $1,700 refunded back to you, thus making a $1,700 refund opposed to a $2,000 refund. That's all that refundable means in this case. So for 2024, the child tax credit is $2,000. For 2025, those numbers are the same. The threshold to the $200,000, I believe those numbers are the same for 2024 as well. So there aren't really any change between 2024 and 2025 as far as the child tax credit goes. Capital gains and qualified dividends, where these apply. Most people have investments in qualified accounts, 401ks, IRAs, 403bs, through a savings plan. The determination of whether those are taxable or not are going to be determined by if contributions were made on a pre-tax or on a Roth basis. Now, you can have investments outside of retirement accounts, and the way that those investments are taxed are determined by the holding period and some other factors. For those that have investments that have been held for 12 months or longer, or if you own a specific type of stock or a favorable type of bond, they may be taxed at a different rate, and these rates are on the screen. So for those who have investments that have been held for a longer term, they're taxed at long-term capital gains and qualified dividends rate. Now, depending on your filing status, if you were someone, again, who's filing single, if your adjusted gross income is below $48,350, there is no long-term capital gain tax on those gains. But if your income exceeds, taxable income exceeds $48,350, you see there's still the 15% long-term capital gain rate. For those who are single that exceed $533,000 in taxable income, this actually taxed at 20. So most people would fall within the 15% long-term capital gain rate. There is no change in the rate prior or between 2024 and 2025. Those things have not changed, but the dollar amounts, right? The dollar amount thresholds for those who are filing single, filing jointly, head of household, or estates, those dollars have increased. Now, additional taxes that you may want to be familiar with, alternative minimum tax. Following the Tax Cuts and Jobs Act, the amount of people that are impacted by this has decreased. So it's not likely that most will see this. However, they did increase the exemption amount. So for 2025, for those who are married filing jointly, you see that exemption amount is $137,000. It's up from $133,300 in 2024. For those who are single, that number is $88,100. That is up from $85,700 in 2024. For those that are married filing separately, it's $68,500. That's up from $66,650 in 2024. And for any estates and trusts that have tax liability, the exemption amount is increased to $30,700, which was previously $29,900 in 2024. Tax on net investment income for those high earners or who have modified adjusted gross income in excess of this amount, there's an additional 3.8% tax on the lesser of either net investment income or excess over that modified adjusted gross income amount. For those married filing jointly, that number is $250 for 2025, $200,000 for single, $125,000 for married filing separately. There is no change from 2024 to 2025, so these numbers are the same this year as they were for last year. Now, gifting and estates, these are the taxes that I believe people think of when they think of their estate plan. Again, with the Tax Cuts and Jobs Act, with the increase in the amount that's excluded from being taxed at this 40% maximum estate rate, they did double that amount, and it has been adjusted or indexed for inflation. So in 2024, if you were someone who has a total estate that's less than $13,610,000, you're likely not someone who will experience that 40% tax on any gift or estate. For 2025, that number is now 13,990,000. And the gift tax and annual exclusion, if you're someone that's giving money to family member, someone in the family, that annual exclusion is now 19,000, previously 18,000 in 2024. I believe they also increased the lifetime. Now, education credits, deductions, and distributions. For anyone that is currently paying for a child to be in school, or if you are currently in school and paying out of pocket, these are some tax credits I do encourage you to research: the American Opportunity Tax Credit and the Lifetime Learning Credit. For the sake of time, not going to go through the full definitions. If you have questions, you're more than welcome to reach out to me. I'm more than happy to schedule some time to explain these. But what you do want to know is for 2025, there is a tax credit for those who may be paying for school out of pocket. Now, it's a $2,500 credit for which only $1,000 is refundable. I know that's not on the screen, but I'm just going to repeat that again. It's a $2,500 credit. Remember, credits go towards the tax liability. Only $1,000 is refundable of the $2,500. Now, the American Opportunity Tax Credit, there is a phase out. So if your adjusted gross income exceeds these dollar amounts, then the amount of the credit that you're eligible to be used will be phased out. For those who are filing a joint return, if your joint adjusted gross income exceeds $160,000, you may experience a phase out of that credit. For those that are single, head of household, married, then you may be phased out of using that credit. Now, the lifetime learning credit, $2,000 credit. Again, how much of this is refundable? I'm not quite sure. Actually, this is a non-refundable credit, so none of this is refundable. So you have to have a liability in order to use this credit. It's a $2,000 maximum credit. Again, the phase outs are just about the same as the American Opportunity Tax Credit. For those filing jointly, the adjusted gross income in excess of $160,000. For all others, $80,000. Coverdell education savings accounts, I would say these I have not had much experience with due to the flexibility and the increase in use of 529 accounts. If you are someone that still owns or has a Coverdell education savings account, there is a maximum amount that you can contribute. That maximum amount is still the same. It's $2,000 max. They haven't really increased these numbers in a few years that I've seen. Now they are phased out. So if your adjusted gross income exceeds $190,000 for joint filers or $95,000 for all others, the amount that you can contribute to a Coverdell education savings account may be limited, but the $2,000 maximum is still in play. Now, 529 accounts, these may be a bit more common in today's time because of the flexibility. As you can see, 529s, there aren't a maximum annual amount that you can contribute. There is a maximum lifetime amount that you can contribute that's in excess of $500,000. 529s also can now be used, as you can see on the screen, for K through 12 planning, right? So if you have expenses K through 12, not just higher education, not just secondary education, you can use a $10,000 distribution from a 529 to pay for K through 12. That's now considered a qualified education expense. It's also good to note 529 plans can be moved to ABLE accounts for any disabled beneficiaries. There is a time limit for that capability. It does expire December 31st, 2025, right in line with the expiration of the Tax Cuts and Jobs Act. So make sure to check with specific states if you were someone who is considering rolling money from a 529 to an ABLE account. Again, that's applicable for any beneficiaries who are disabled. You do want to consult or check the state requirement because some states are decoupling from federal and not treating the 529 plan withdrawal for K through 12 expenses as a qualified distribution. Shifting gears to retirement plans. So there's some things that have changed for how much you can contribute to a retirement plan. As you can see on the screen, there are many different types of retirement accounts. You have 401ks, 403bs, 457s. For all of my federal government workers, thrift savings plans likely will follow contribution limits with 401k and 457s. The annual compensation used to determine the contribution for most plans is $350,000. The defined contribution plan basic limit increase is $270,000. That's higher than $69,000 in 2024. For all defined benefit plans, the basic limit is $280,000. Defined benefit would be commonly known as pension plans. But for most people that are participating in 401k, 403b, 457, that increase, the maximum amount that you can contribute to those plans are now $23,500. That is $500 more than what was allowed in 2024. For all of my people turning 50 or older, you see that there's a catch-up provision. So there's an additional amount that you're able to contribute towards 401k, 403b, 457 plans. That amount is $7,500 in addition to the $23,500. That is an increase from, that's the same as it was in 2024. Apologize, same as it was in 2024. But something new that is, I would say, becoming more common knowledge, with the passage of the Secure Act 2.0, they added another catch-up provision for those that are 60 to age 63. For those that are age 60 to 63, they can contribute $11,250, not just the $7,500. So there's actually more that anyone that's age 60 to 63 can contribute from $7,500 to $11,250. Once you turn 64 and older, you go back down to the $7,500 limit. For those that may be participating in the simple plan, if your employer offers a simple plan, the elected deferral is $16,500. IRAs, right? So the IRA contribution amount, those are the same from 2024 to 2025. So for those that are making contributions towards an IRA, the number is still $7,000, or a Roth IRA is still $7,000. Please remember, these are in total. These are not separate. So you cannot put $7,000 into a pre-tax traditional IRA and then do $7,000 towards a Roth. The total amount, $7,000, is a combined amount for 2025. They still allow a catch-up contribution of $1,000 for anybody that is 50 or older. Your total is about $8,000 per year. Now, what has changed, you see the income limits for who is eligible to either take a deduction on money that they put into a regular IRA, or for those that can contribute towards a Roth IRA, those income numbers are a little bit higher. Shifting gears to health, away from retirement, for all of my people that have high deductible plans and are contributing to a health savings account, they have increased the maximum deductible contribution. For those that may not be familiar, health savings account, it's kind of like a triple tax benefit, if you will. One, money goes into a health savings account on a tax reduction or tax deducted basis. So think of these like pre-tax contributions, no different than 401k, 403b, 457 contributions. So they go in tax deferred. The money that you maintain in a health savings account can be invested. And since you can invest those monies, there is a tax deferral on the growth. So there's no taxes on the growth that occurs in a health savings account. And for all distributions that come as a response or a reaction to a qualified medical expense, the money can be withdrawn tax-free. So that's the three tax benefits. It goes in before taxes, grows tax deferred, can potentially be used tax-free as long as the money is used for qualified medical expenses. So the maximum deductible contribution for 2025, these are for contributions throughout the course of this year. For individuals, that amount is $4,300. For families, if you're part of a family plan, that's $8,500. And for anyone that's 55 or older that fit in that criteria, you have an additional $1,000 contribution as a catch-up contribution towards the HSA. Deductibility of long-term care premiums for those taxpayers who are paying for long-term care, they generally can deduct a portion of the premiums as a qualified medical expense. The deduction varies based on the taxpayer's age, as you can see, and it's subject to a 10% floor for medical expenses. I believe this falls in line with one of those itemized deductions. So you do want to be familiar with your ability to use itemized deduction opposed to a standard deduction. Medicare premiums for all of those people who are enrolled in Medicare Part B. If you're enrolling in Medicare Part B this year as you turn 65, The premiums for Medicare Part B start at $185. Now, if you were someone who is in retirement and you're benefiting from the hold harmless provision, that provision is essentially saying if the increase in Medicare premium exceeds the increase in your Social Security, then the Medicare premium likely will not increase to 185. So it is possible that some people in retirement are paying a little bit less. But as you can see, depending on your total combined income, your Medicare Part B premium can actually be higher. Now, if you're looking at the screen and you see 2023 and you're wondering why we're talking about 2023 when we're supposed to be talking about 2025, Medicare has a 2-year look back. So the amount in premium that you pay for Medicare really is determined by your modified adjusted gross income based on your 2023 tax filing. So if you have excess distributions, if you made more money in 2023 than what you made in 2024 and 2025, understand that your Medicare Part B premium is determined by what was earned or taxed in 2023. Why this is important, you want to be familiar with the income adjustment, the extra distributions from qualified accounts such as IRAs and 401ks. Those could potentially bump you up into another bracket as well as impact your Medicare Part B premium. Closing with Social Security, some Social Security things that you do want to be familiar with. The estimated maximum monthly benefit is now $4,018 for anyone that is turning the full retirement age. That's 66 and 10 months in 2025. So if you're coming eligible, the maximum monthly benefit would now be $4,018. That is up from $3,822 in 2024. Retirement earnings exemption amounts, those are just about the same. The maximum taxable wage base in 2025 is $176,100. That's up from 2023's $168,600. Tax rate remains the same for anybody that's an employee. 6.2% of your earnings are taxed into Social Security. Your employer pays the other 6.2. For all self-employed people, the tax rate for Social Security is still the same, a total of 12.4. Now, the tax on Social Security, these provisional income numbers have not changed in I don't know how many years, but it's been decades on decades. So depending on your filing status, I want everyone to know that up to 85% of your Social Security can be taxed at a federal level. Now, depending on your filing status, if you were someone who is single, head of household, a qualifying widower, or a married filing separate and living apart from your spouse, your provisional income. Now, earlier we were talking about adjusted gross income, modified adjusted gross income. Provisional income is something even more complex. Provisional income is the combined income of your adjusted gross income plus the non-taxable interest that may be earned from municipal bonds or international bonds, and then half of your Social Security benefits. So you have a lot of things that can be used into that calculation. For those that earn over $34,000 in provisional income, up to 85% of your Social Security can be taxed. If you're married filing jointly, that number is $44,000. So if your provisional income exceeds $44,000, up to 85% can be taxed. If you're married filing separately, anything that you earn will be, up to 85% of your Social Security will be subject to taxes. So a lot of numbers, a lot of information. As you see, I was looking up and down. I was using my 2024 key financial data. For those that are participants today, you can expect an email. I will be providing you the 2025 key financial data. What you can do with that information is schedule some time with me to discuss your situation. We have a lot of different tools and resources to project based on 2024 and what you filed for 2024 and what you're expecting to earn. Maybe you're planning a withdrawal or distribution from retirement. How will that impact your taxes for 2025? We have ample tools and resources to provide a perspective of what you could expect to pay for 2025 as far as taxes go. Now, been running for a few minutes. I'm going to pause for any questions to check the Q&A feature. Don't quite see anything in that box just yet. And if not, then I will bid everyone a wonderful and blessed evening. These are the disclosures for the presentation. What you can expect, again, is a follow-up and please be on the lookout for email for the video replay. And I bid you all a wonderful evening. Thank you again for joining.